Hi everyone, welcome to episode 12 of our weekly lives. And I am super excited to talk about the basics of hard money lending with fix and flip loans, DSCR loans, and we're going to keep it to the basics, 1 to 4 families. And today there was a question. Let me step back. So my name is Adam Levine. I'm a private lender, hard money lender, Gator lender. Thank you to Pace Morby. He got me super excited about Gator lending, and we actually are very, very bullish on Gator lending in our business model. Been private lending for over a decade. We work with different buckets of capital, institutional. We have private investors that fund loans with us, family, friends, and we are excited to talk about um, fees. And this is episode 12 of a series we're doing of lives. And this is this is an interesting episode where a lot of people don't understand the basics. And sometimes it's overlooked, and a lot of people are. I remember we had a networking event. It was a few weeks ago, and it was savvy investor. It was actually a very savvy investor. The gentleman was bankable. He uses hard cash. He said, or he goes to conventional banks, and he was asking me why hard money. And then I explained to him that first of all, it's the speed, right? Speed, less bureaucracy than going to a traditional bank. No tax returns. You can close in as little as a week, even close in 24 hours, right? And that was a big plus to him. Obviously, leverage, right? Because he says, I buy cash. I'm like, well, leverage. I mean, leverage is key. OPM. I mean, if you're going to buy a house cash, I mean, unless you have a printing press, you just print money and just buy houses, then obviously, but no one has a limited amount of money. So it allows you to scale up to do multiple deals. And you could have, and so he was like, whoa, that is very interesting. He had no idea. He was blown away. So we spoke about this on the last week's episode, and now what's interesting is that I actually had some comments uh the in the comments section, basically, and one of the comments was what are typical fees associated with these fix and flip loans? Okay. Um, I'll even take it a step further. We'll talk about DSCR loans as well. Debt service cover, service coverage ratio. Fix and flip loans, the step back, are term. They're short-term loans, typically 12 months, could go 18, maybe 24 months. Um, those are meant to either buy a property it could be just a bridge loan just to buy where it's rent ready and there's no renovation. um, Let me step back. Okay. So a bridge loan could be to buy a property, you need to close quick, and basically the property is ready to be rented and there's no renovations, right? A fix and flip loan could these days could be used interchangeably. And what's interesting, originally these are like called hard money loans, and then as the industry evolved, now they come up with these fancy names: fix and flip, fix to rent. Right? I'll show you the website: fix and flip, fix to rent. Um, I could probably give you an idea. Let me give you a little visual, right? So we're redoing the website, and let me go back because I'm getting what happened here. I gotta tell my web guy something is wrong with the website. I gotta Let me see something real quick. Hmm, I gotta have him fix that. But okay, so we're actually in the maintenance stage, so he's fixing stuff, and for some reason there's a glitch, but he'll fix that. So we have fix to fix and flip, fix to rent, um, bridge loans, long-term rentals, new construction, multifamily portfolio loans. Okay. We're talking about, let's keep it basic. We're talking about fix and flip and bridge loan and long-term rental, right? Um, Basically, a bridge loan is short-term financing. It's basically you have to close quick. There's typically no renovation monies involved. You got to close quick, and maybe 24 hours, maybe as little as a week, whatever it is, right? Instead of having to go to a bank and they're underwriting you full, they'll look at all your tax returns and everything. A bridge loan, there's no tax returns required. Track record is important. Obviously, it's asset based and everything. A fix and flip is basically you're buying the property, you're going to renovate it to either sell or refinance. And then they came up with this fancy term, fix to rent. That's a little, I got to have the web guy fix that. It was good this morning. I don't know what happened, but I know he's been making a lot of updates. So fix to rent means you're going to buy it, you're going to renovate it, and you're going to refinance into a long-term loan over here, right? And that is odd. I think there's something. Let me see something real quick. I don't know what's going on with the website. Let me see something real quick. So let me go back. I'll talk to my IT guy later and we'll fix this. But anyway, so let's just talk about fees. That was what this episode was about, are the fees involved. Let me show you a typical term sheet. I'm going to show you a typical term sheet. And let me do this real quick. Give me a second. This is a typical term sheet that we send out, and I could kind of just break it down. And I could even tell you about some hidden stuff that lenders do as well that you have to watch out for. You may not know about it until it's too late after you close the loan. So let me show you what happened here. No. Sorry about that. Here we go. Thought my computer's gonna shut down on me for a second. So here's a term sheet that we send out. And basically, let me show you real quick. So here's a term sheet that we send out. And basically, estimated closing costs and cash requirements. Okay. So keep in mind, you typically have your origination fee. So lenders make money on the interest rate. They make money on points, and there could be possibly a processing fee. There could be an underwriting fee. There could be maybe an admin fee. There could be I even heard some lenders charging a draw setup fee or something like that. They sneak that in there. And they could finagle stuff to maybe say, hey, you know what? Maybe there's no points, but they'll make money on these other fees. All right. So let me just show you a typical term sheet right here. Right. So we keep it very simple. So the lender, so this is 12%, right? We're giving a loan at 12%. This is 12% fixed rate interest only, right? 12 months, no principal pay down, right? Non-Dutch basically means that you're not paying interest on. So for example, right, if you see right here, the total the initial funding is 75% of the purchase, right? This is for the acquisition of the property, right? The renovation budget is $56,000. Now the client is not going to get $56,000 on the onset, right? That money is going to be held in escrow. And in order for them to tap into that money, they have to complete work, right? And then they submit a draw request, then they get reimbursed the money dollar for dollar, right? And non-Dutch means they're not paying interest on this $56,000 until they use it. They don't. You're only paying 12% interest, and it's annual, right? It's annual interest, so it's basically 1 point a month on 187,500, right? That $56,000, if it's a Dutch loan, right, means full boat, you're paying interest on everything, even if you don't use that $56,000, okay? And then let's say your initial loan is 187,500, you complete $10,000 worth of work, you submit a draw request for $10,000, you're going to pay, let's say, a $300 inspection fee for the inspection and to get reimbursed. And then basically you're going to submit a draw request. You're going to, we have something where we use virtual inspections, cost you $300. You take pictures, submit to us, cost you $300. You get reimbursed the money 24 hours, right? and then now your unpaid balance becomes now 197,500 because you just basically um now you borrowed additional $10,000 basically, right? Um and that's just to keep it simple. If you have questions, please put it in there and I could probably break it down even further, or I could always talk about another episode, right? Now, um origination fees, right? So um typically origination fees are they that's how lenders make their money. I mean, when I first started over a decade ago, 4% was pretty typical. 4% and 14% interest. So what happens is this actually is well, this is just a not a real term sheet. This is just a hypothetical scenario, but typically I would say points are probably around 2% or less for us at least. Um, That's typically so basically you're gonna pay points on the total loan amount, right? Typically. So like that's one thing you have to just be cognizant of is that your total loan amount maybe let's say is 243,500. That takes your initial funding of 75% plus the renovation budget, and you're gonna pay well here it says 3.5 points on the total loan amount. That equals $8,552.50, right? That's one fee that a lender makes. There could be a broker fee, right? Maybe there's an intermediary on the deal. You're working with a broker. The broker's trying to shop lenders, get you the best deal. And the lender, like us, ask the broker, how much do you want on the loan? And how much you want to make on the loan? And they say, oh, yeah, I want to make 1 point. Great. So then we'll add the broker fee, 1%. And then 1% of total loan amount would be $2,043 and 5. It would be basically just do 1% of 2,400 and the $2,435, right? That would be 1% of that, right? That will go to the broker, right? That'll be paid on the HUD. Then you have a typically you have a processing fee. That's another fee that lenders may charge, right? So that's another fee to the lender. And then there's legal fee, right? Legal fee could be for us. I mean, we that pays our attorney to full service legal, so that doesn't go to us. That goes to the law firm. But some companies they may draft their own loan docs. We have that capability too, but we like to use full service legal. But typically, there's a legal fee to draft up loan docs, right? Um, wire fee, right? So a wire fee is basically keep in mind. I forgot to mention that lenders never pay anything. So whatever fees that are incurred to make the loan, such as a wire fee, such as a legal fee, such as whatever fees that come, that's always a pass through to the borrower. The lender never pays any fees. Borrower always pays, right? So typically, we add on a wire fee because it's not because it does cost us money to wire out monies, right? So we add that's just a hypothetical scenario, $60, right? Admin fee, this is like I said, this is all um just give you a snapshot, but an admin fee could possibly be on the loan as well. That is I guess they call them junk fees, right? That's more income to a lender. And there's some other fees that I don't have on this term sheet as an example. You could have possibly a oh, you know what? I forgot something on here. Appraisal fee, right? That's important. So most lenders require appraisals, but some lenders they don't, right? But appraisals are typically, let's say, $750 or less, could be more, right? That is something that borrowers have to pay. So keep in mind, like when a loan's kicked off, right? And the first thing that you have to do is you have to, credit background check is done, right? And then borrower has to pay for an appraisal, okay? And that typically, like I said, is about $750, could be less. We always estimate 750 just to be on the high side. and that's another fee that's not on here. But the borrower has to pay that upfront. All those other additional fees, such as origination, broker fee, processing fee, wire fee, admin fee, that's all paid at the closing on the HUD. That we paid at the closing. Some lenders, they ask for a commitment fee up front. We don't do that, but some lenders do. And that's just basically they want you to have some skin in the game, so you're not wasting their time, their resources, and um, so they want to know that you're committed and not shopping them, and that's usually non-refundable. Or maybe they'll say, hey, commitment fee, you paid up front, and they will credit it back on the HUD if you close with us. If you don't close, you walk away, then you're out that money, right? There's title insurance, right? That's not on here. So title insurance is another thing that you have to pay. You always have to pay that. That's something that you're going to pay on the onset. Like you need to pay that. There's an exit fee. Could be something else that some lenders have. Usually commercial loans have maybe 1 point. Like if it's a commercial, like a 5 year plus, you may have a 1 point in, 1 point out. The 1 point out is an exit fee. Some lenders also can they can sneak in. I've seen this happen where basically it may not be on the term sheet, but what will happen is like, okay, well, the loan, it's a 12-month loan, but the loan goes past 6 months, they're going to bang you for 1% of the total loan amount. And then so then when you receive, like when you ask for a payoff, right, from the lender, all of a sudden you're going to get the breakdown. 1% exit fee. You're like, wait, I have that. And they'll surprise you with that. But if you look at your loan docs while you're signing, you should be able to catch that. But that they could sneak that on there. We don't do that, but I've seen lenders they'll do that. There could be an underwriting fee, right? An underwriting fee is another fee that lenders could charge as well. So they may have a processing underwriting fee. And just want to see if anybody's on here asking questions. There's some other fees that I know. Like I said, draw setup fee. I heard some lenders, what they'll do is they'll sneak that in there. And for example, let's say like a lot of borrowers maybe they pay attention more to like origination points. Like they're like, oh, I got to pay 2 points. So maybe, I mean, we'll do it as well. I mean, I'm not going to say we don't. And actually, it's more beneficial to the borrower. But we may say, you know what? For example, a DSCR loan, we could do 0 points on a DSCR loan. DSCR loan is a term loan. That's a long-term loan, typically for rental properties, right? You're going to buy the property, you're going to rent it out, typically 30-year term. It's amortized over 30 years, and after 30 years, it's paid off, right? And what we could do is we could charge 0 points, but we'll make money for us because obviously we can't work for free. Or no lenders go work for free. I mean, they say, we have a minimum earned of $3,500 we want to make on the loan. So they just have maybe a $3,500 processing fee. Meanwhile, you're still saving money because they're not charging you points. But a borrower may say, oh my God, I have no points, and not pay attention to the additional fees like that processing fee of $3,500. So those are things you could finagle numbers and stuff like that. There's other things too that you have to look out for. Prepayment penalties on a DSCR loan. So typically DSCR loans have prepayment penalties. There are ways to finagle where you have no prepayment penalty. Generally, the rate's going to be higher. If you want the cheaper rate on a DSCR loan, it's a 5-year prepay. It's a step down. Okay. And the reason why is because the DSCR loan is not a bridge loan. It's not meant to buy a property and then refinance and sell in 6 months or less or a year. It's meant to be long-term, and investors that investing in these type of loans, they want to make their minimum yield. They're not looking to buy this loan and be paid off, right? So typically, to discourage you from paying off the loan early, they have prepayment penalties. And for example, this is not a term sheet for a DSCR loan, but typically, to break it down very simple, after, let's say, a 5, 4, 3, 2, 1, keep it simple. On a DSCR loan, you decide to pay off the loan within the year, you're going to pay 5% in the total loan amount. Second year, it steps down. You decide to repay the loan, it's 4%. Then it becomes 3%, 2%, 1%. And then after 5 years, you're not paying a prepayment penalty. And we can finagle things where basically maybe you could do a 3-year prepay, and then the rates could be slightly higher, but you're not going to be locked in for 5-year prepay, and it just steps down. And it's really that simple. Another fee for, let's say, 12-month loans are extension fees. So typically, extension fees means that you have your loan matured, and let's say it's a 12-month loan, your loan matured, and you need additional time. So the lender was expected to be paid back. And this will be in your loan documents, and it will be spelled out. Oh, okay, for an additional 6-month extension, they'll charge you, let's say 1%, right, on the total loan amount, or maybe 1% for additional 3 months, and then another 1% for another 3 months. That's typical that we see, but it could change. Basically, you are asking the lender, oh, I need additional time. The lender's like, fine, I grant you an additional 3 months. However, it's going to charge you 1%, and that 1% will be calculated on the payoff. So then they'll figure out whatever the payoff is, and they'll add that 1% to the total loan amount, and that will be included on your payoff. And that is pretty much it. There's really not much more here that I could think of. I mean, there's more stuff there's some other things that you have to watch out for that I may be missing here. But this is pretty much it. Any questions that anybody have? And feel free to ask in the comments. But that's basically it. I mean, these are fees. Look, lenders are entitled to make their money. I know people call them junk fees, but look, we like to keep really good for us. We like to keep good economics for the borrower. So we are cognizant of the economics for you. And we don't like to add on a bunch of junk fees on our loans. Like I said, I heard some lenders, they'll finagle things, and they'll hit you with a large draw setup. I heard about that. I never heard that until maybe a few months ago. But typically, I would say the typical thing is you'll see maybe an underwriting and processing fee. Underwriting processing fee, maybe, I've seen some lenders charge $3,500. Our underwriting fee is $1,525. Sorry, our processing fee is $1,525. Our points are typically 2% or less. Interest rates are 11, 12% for us for fix and flip loans or bridge loans. And I mean, that's pretty much it for us. So anyways, thank you for listening to me. I appreciate every one of you. And please leave comments in there, and feel free to ask me any questions that you have. Let me show you something. So we updated our website too. Give me 1 second, please. So, I don't know what happened here, but the website was working good. Yeah, I got to talk to Morris because he's my web guy, and somehow things look different. Let me see some real quick. But that's pretty much it. So if you ever have any questions, you could always book a meeting with me, right? Book a call, right? You can always book a call to speak with me. If you need a proof of funds, feel free to use the proof of funds generator, okay? If you need a quick quote, it takes less than 5 minutes to do. Please use this. If you want to submit a loan out, email is not the best way. Text message is not the best way. Submit it in here, right? Takes less than 5 minutes. It's going to ask you, are you broker or gator? If you're not, say no, put the target closing date. choose I'm looking for a fix and flip, right? And you'll be done in less than 5 minutes. And then it's going to populate into our system. And then after that's done, then book a call because then at least we have something to talk about, right? That and the reason why I'm not trying to make your life difficult, it just makes our life a lot easier. So loans don't get lost because I get a million emails and it may take longer for me to get to. It could slip through the cracks. This won't get lost. This is the most efficient way. Anyways, thank you so much for listening to me, and I'll see you next week. Take care.